We started to talk about it on Monday. Netflix is going to be reporting earnings tomorrow after the close at approximately 1:01 p.m. That's what they said in their press release on March 14th. We're going to talk a little bit about that and the unusual situation that's going on in Netflix options as a result of this reporting date and time today on open interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic, where we talk about stocks and futures and options, things like that, and take your questions. And one of the questions that came up on Monday was a viewer was asking about a calendar spread where they were short a call spread that expires tomorrow. If my memory serves, I think it was the 985, 1025, a $40 wide call spread. And then they were long a longer dated call spread that expires the following week that was actually in the money. At the time that we had this conversation on Monday, Netflix was trading in the 930s. It subsequently rallied quite strongly up and through 980. I actually am not 100% sure what the absolute high price that it got to was. But it did bring up an interesting point. And the interesting point is this. All publicly traded companies in the United States report their earnings quarterly. Other than Berkshire Hathaway, which reports and then has their earnings call and information all released on the weekend, companies typically report in the first 4 days of the week, Monday through Thursday. So a Thursday after the close earnings release isn't hugely unusual by itself. But what is unusual is that in this case, it is coming before a holiday. Good Friday is the day after tomorrow. The markets are closed. So rather than expiring on Friday, as the weekly options normally would, instead they expire tomorrow. And that sets up something a little bit unusual if one happens to be trading these options. Now, I'm going to just give you this little bit of warning ahead of time that some of the things I'm going to get into here are not hugely complex, but it is important to understand the specifics, because if you trade options that are expiring, you may need to do things after the close, depending on what happens to the stock. And if these are things that you have not done before, then you might want to avoid trading options. This isn't necessarily financial advice. I'm not your financial advisor. I'm just a long-time options trader. But I think this is important to understand, because the normal course of things is that you don't have major catalysts that can move an underlying stock materially after the close on expiration. So it's not normally something that you really have to pay a whole lot of attention to. The other thing that's interesting here is that, of course, Netflix is a very actively traded stock. When I looked at it most recently, there was 554,000 open interest in the options. And, of course, there are stocks with higher open interest than that. But Netflix is a $1,000 stock in round numbers. So that's a huge amount of open interest. So I thought we would just talk a little bit about Netflix and then get into some of the specifics and the weird things that can set up. And it can be both a risk and it could be an opportunity, depending on how you are positioned and how you understand these concepts. So the first thing I wanted to do was just bring up a chart that I have loaded up here. So this is a chart on unusual whales, and let me just explain what it is that you're looking at. So the dotted line here is the average movement for Netflix going into earnings over the last 11 reported quarters. And I say it on the right here, it says 12, but this is the dotted line represents the last 11. This is the 12th. This is where we are right now. So you can get a sense of how Netflix has been behaving relative to its historical performance on average going into earnings. One thing I think is rather interesting to note, and that is that, okay, so the stock sort of fluctuates around. It's a little bit higher, a little bit lower going into earnings. But then when earnings comes out, we'll notice that on average, it's decidedly higher. This is obviously a great performing stock. It hit highs not that long ago. It's one of the sort of few really well-known mega cap stocks that is up on the year. And let's see where it actually closed today. It was up 9% on the year when I looked at it most recently. And it closed up 7.89% on the year. And this, of course, at a time when the market is down and chopping around, and some other stocks like Tesla have been very hard hit. So the S&P is down 10% on the year in round numbers, and the NASDAQ is down just under 12.99. We'll call it 13% on the year. One of the reasons that Netflix has outperformed, there's a couple of them. Obviously, they have continued to operate and execute very effectively. Perfect example of this is how the company has transformed itself. Naysayers for the longest time used to look at this and say, oh, this is a company that's ultimately going to get buried by content costs. And they just figured, sure, they're going to take on more and more subscribers, but they're never going to get any free cash flow. And for a very long time, the company didn't. We can take a look down here at this bottom row, and you can see here they had a couple $100 million, then they started losing some cash. And then for years, they were losing more and more cash each year. So we can see 2012, they had negative free cash flow of $67 million, 2013, negative 22, negative 128, negative 900 million, negative 1.6 billion, negative 2 billion, negative 2.8 billion, and so on, negative 3.1 billion. And the idea was, yes, the company is growing, but is this thing ever going to start generating any free cash? The bulls said, much like they said in Amazon, it should also be said in fairness, they're building their business, they're getting ever bigger market share. They're going to basically own the space, and then eventually they can turn the spigots on and things are going to get good. Sure enough, in 2020, first really big free cash flow year, little bit of a hiccup there in 2021, and ever since it's been off to the races. So 1.6 billion in 22, almost 7 billion in 23, 7 billion for last year, and now the forecast for full year 2025 is 8.5 billion, and they're looking for 11 billion in free cash flow for next year. 11 billion in free cash flow for what it's worth. So now we're getting into, pretty attractive territory, 2.7% free cash flow yield relative to enterprise value or market cap, since those two are basically the same number, again, in round numbers. Okay. So what is the interesting dynamic that's going on here in Netflix going into earnings? Well, first things first. We talked about this on Monday. This is a stock that has a big implied move. Right now, we're looking at an implied move of about 8%, which is pretty material for a $400+ billion company. Call it a $32, $33 billion market cap swing this way or that. But what's particularly interesting is that as big as the implied move and as big as they have been historically, the actual moves have generally been much larger. We can see, looking at the last 11 reported quarters, that most of those, 8 of 11, actually exceeded what the options market expected. And in this one right here, so if we go back all the way to the second quarter of 22, we can see that the actual move was 7.35%. It was expecting a slightly bigger one, but that's a pretty chunky move, and if one bought the straddle, that's not a complete disaster. So it was in this context that we were looking at it. I have described this thing as essentially an unregulated utility. One of the reasons I think also that the company has outperformed this year is because people have viewed this as being somewhat more immune to all of the tariff tumult that is going on. So you have a company that is growing and that is operating. It seems to be a service that people are largely addicted to at a price that it seems unlikely that they would cancel their subscription. They would stop. If discretionary spending drops, it might be one of the last things that people stop spending money on, because if you're going to go out to dinner less, if you're going to go out to shows less, you're going to see less sporting events, you're going to go out to the movies less frequently, this is a source of entertainment that remains affordable, remains convenient, and you can remain at home. So for all of those reasons, it's not that surprising that the stock has outperformed the broad market by about 20% in the case of the NASDAQ, and in the neighborhood of 17-18% in the case of the S&P. So we're all good there. This is where things get a little bit complicated, though, because the company is reporting after the close tomorrow, and that is also options expiration. I think it's very important for people to understand what's going on. Now, understand first that whatever brokerage platform you use, their rules or guidelines about how you can interact with your positions after the close may vary. So I think I have somewhere over here what Interactive Brokers, I looked up Interactive Brokers because I happen to use them, what their rules on this are. But there's an overarching thing that's important, and that is that the Options Clearing Corporation expects the clearing member firms to advise them on any exercises or contrary exercise notices by 5:30. So what that means is that if you have an account at a clearing member firm, Interactive Brokers is a clearing member firm, Merrill Lynch, all of the big wirehouses are members of the clearing corporation. What it means is that you have to advise the OCC if options that do not expire at least a penny in the money are going to be exercised, because as a courtesy, the arrangement between the clearing house and the clearing firms is that they automatically exercise options that are at least a penny in the money. So in the case of Netflix, if Netflix is trading $9.50 and 10 cents, the $9.50 calls will be automatically exercised as sort of a convenience feature. And this is it. The intent of this is good. The intent of this is to make sure that if options traders purchase options that are in the money and are therefore theoretically profitable, or at the very least, therefore have some value relative to where the stock is trading as of the close, that they're exercised automatically. And you can imagine that makes things generally a little bit easier. So let's just walk through that example first. Let's assume that you own the Netflix 950 calls that expire on Friday. So we're just going to put that up really quickly here. So 950 calls. Okay. So you own the 950 calls that expire on Friday. These calls right now, as of today's closing price of $961.63, and actually we could make up the 960s. Why not? We'll make it something closer to at the money. That might help illustrate the point a little bit better. Okay. So the 960 calls are $1.63 in the money as of the close tomorrow. That's our assumption. That is very close to at the money. So they would automatically be exercised because they're at least a penny in. But that's only 17 basis points in the money based on the current stock price, because this is a nearly $1,000 stock. So the question for anybody who's trading Netflix options, and this is something to think about on any expiration, but this one's particularly important because the stock can move after hours, because that's when they're going to be reporting earnings. So let's assume that they report earnings and the street doesn't take the news well. And we see a move consistent with the implied move that the options are expecting, I call it 8%. We see it to the downside. All right, so it's going to trade now at 92% of the stock's current stock price. That's $885-ish, okay? Well, if you owned the 960 calls and the stock is trading at $885, would you want to exercise those calls? Obviously not. Even if you wanted to own the stock, you would simply contact your broker, give a contrary exercise advice, which is saying, look, I know these things expired in the money. And by the way, in the money as far as the brokers and the clearing house are concerned is the official closing price on that day. So it's not as if the stock is bouncing higher or bouncing lower, they're keeping track of that, and now the stock's trading $885, and they're like, oh, well, those were in the money as of the close, but now they're not, so we're not going to exercise them. They have to basically find a specific time, and the time and price are the official closing price that day. So If you held these options, you would then file a contrary exercise advice. On the Interactive Brokers platform, it's the same mechanism that you use to actually exercise your options. You just go, you collect options, you go to the options exercise thing, and then you can just say, no, I don't want to exercise these options. I don't know what your brokerage platform rules will be. In the case of Interactive Brokers, based on the guidelines that I have read from them, you must enter it into the system by 5:25 p.m. Eastern Time. Is that true for your broker? I don't know. You would have to check. But it's really important to understand this and be able to make a choice about that. So I decided today to execute a small trade on a test basis to illustrate something that kind of interesting can happen. So what I did today was I bought, and this was just it was a test trade, and arguably you could say I overpaid. This is not a recommendation. This is for illustrative purposes only. You can again do what you like, but I did it actually for this because I wanted to make sure that the complex order book was working the way it should, and that the prices I was going to use are actually representative of what can actually happen. And I bought a 952.5, 950, 947.5 put butterfly. Okay. So what that would be buying the 950. Oops, it doesn't really matter if it's calls or puts, but these are out of the money. So bought one 952.5 put, sold two of the 950 puts, and then bought one of the 947.5 puts. Now, I want to just illustrate why having options expiration on an earnings in a stock that moves a lot, that has a lot of open interest, can have some very important implications. So right now, this whole put fly is out of the money. And actually, the way this thing is scaled, it's actually really hard to see. So let me see if I can mitigate the... Let's see. I'm going to do this. Can I slide that and change the picture? I cannot. All right, never mind. Oops. Yeah. So what I was actually trying to do was change the trading range. I'm going to do this. Take that in. Does that change the picture? It doesn't. All right. Well, let's just sort of walk through this. Hopefully, I'll be able to kind of explain what we're getting at here. So let's just take a look here. So this is where the stock is. And actually, let me shorten this up a little bit. We don't need a 6-month chart. Just use 1 month. Okay. All right. So the stock is here. Same example that I just gave. Stock's trading here. You see an 8% move to the downside. That takes us down around here, 885. Now, I own the 952.5 and the 947.5 puts, right, as a part of that strategy. Now, those expired out of the money. What do I want to do? Well, if the stock's trading 885, each of those options is now far in the money, right? So we're talking about options that are $60 plus in the money. Each contract is worth $6,000 now. So I want to exercise my puts. So I go into my system and I say, these are not options that were due to expire. Let's say it's 5 o'clock tomorrow afternoon. So I say exercise the 952.5 puts. I sell 100 shares at $952, so $95,200 collected for that, and then I exercise my 947.5s. So I sell another 100 shares there. So now I'm short 200,000 almost of Netflix at an average price of $950 a share. But what now? Now, if I simply owned those puts, and had no other position, what would I do? Well, I would go into the after hours and I'd probably just say, okay, unless I really wanted to lean short Netflix, just said, I think this news is bad and I think it's going to get worse, so I'm happy to be short 900, close to $200,000 worth of the stock, so I could just leave that position on. Or if I said I just want to capture the value of my puts, I would simply buy back 200 shares at $8.85 a share, right? And so then I would make the difference between those two. So I'm short 200 at 950. I buy it back at, we'll call it $8.85. So I'm going to make $65 a share on a 200 lot, and I'm up 13 grand. All good. Not so fast. Because I'm in the put fly, I'm still short a 2 lot of the 950s. And I don't know what the other side of those is going to do necessarily. So if it's an institution, a dealer, a hedge fund, anybody who's paying someone to, watch every single option that's on their book until the last possible minute, they will certainly exercise. But what about retail? What about the guy who at noon thought, oh, I think Netflix is going to trade lower going into earnings, and went on to his Robinhood app and bought one of those puts? And then the stock closed at 960 and change, and is like, I guess it didn't work out. Gets in his car and is going to Palm Springs for the long weekend, and doesn't stick around for earnings, doesn't find out that the stock plummeted by 8% afterwards, and does not. Well, those people don't exercise their options. What if that person does know about earnings, does want to exercise the put, but only has $5,000 in their account? Well, if you have $5,000 in your account, I don't know how most brokers are going to treat this, but I'm guessing when you go to hit the I want to exercise my put button and sell $95,000 worth of the stock, they're not going to let you do it, because $5,000 in net lick isn't going to cover a $95,000 short in Netflix. Now, again, how individual brokers handle that, I don't know. But what it means is that tomorrow afternoon, after the close, there are going to be options that were out of the money as of the close that are in the money within 45 minutes of the close, because they're going to report earnings and the stock is very likely to move. There's a chance it doesn't. There's a chance. But it's not a very good one. The better chance is that the stock moves in one direction or another. And the reason this is important is because if you are on the other side of this, you don't know what's going to happen to you. And you might hope nothing does. So if I if I exercise my puts tomorrow afternoon and I sell a couple hundred shares at 950, which if I don't close this thing out is a possibility if the stock declines, well, now I'm riding a $200,000 short in Netflix over the weekend. I'm riding it at a presumably good price. If I'm short at 950 and the stock's trading 885, I can lose if the stock rebounds, but it's got to go back 7.34% just to get back to break even. So not a terrible spot to be, right? If somebody says, you have an opportunity to sell the closing price in a stock or something very, very close to it, and you know that it's trading down 7, 8, 9% after hours, you're not 100% sure that you can short it there, but maybe you are. You'd probably say, you know what, on a coin toss, I'll take that bet. The news was bad. They thought it was bad. The chances that the stock recovers by Monday is maybe slim. But at the very least, you're starting out ahead of the game, right? Because you're short the stock away. Now, what's interesting about this is that this could cause a whole lot of volume if institutional traders decide that they want to try to shoot against that open interest. if people are going to say, you know what, we think there's a decent chance that some portion of these options that should be exercised are not. And we want to take advantage of that. Now, I had somebody else I was talking to earlier today do a little lookup, and he said that according to ChatGPT, something like 10 to 25% of all options that end up in the money by the last moment that you could exercise them that were not in the money as of the close, it's like 10 to 25% of those options. I think that in a name like Netflix, those numbers could be substantially higher. And it's because there will be people who are not paying attention. There are folks that have positions in those options who it's maybe not registering that Friday's a holiday. When I was asked this question on Monday, that was actually where I was at. I wasn't really thinking about it, to be honest. When I was asked the question, the first thing that occurred to me was not, oh yeah, wait a minute, Friday is Good Friday and we're not going to be open. So Alex V said, Netflix high options volume for the June 950 puts and the April 1000 calls today. Well, this is interesting. We can go to take a look at the open interest in Netflix. And I'm just going to look out to options that expire, relatively soon. I have only, if you look over here, I don't know if you can see this. Let me blow this up a little. Okay. So these are all options that expire on Friday. And I've sorted these by their open interest. So if we look over here, we can see the open interest. And one of the things that's kind of interesting and funny about this, and I noticed this when I traded the 952.5, 950, 47.5 put spread, that all the open interest is going to be on strikes that end in 5 or 0. Like in a $1,000 stock, it turns out, nobody's really interested in trading the 952.5s. They'll buy the 950s, 945s, and so on. So what is interesting is that if you trade $2.50 put spreads, and you want to be short options that have a lot of open interest that might be in retail hands, sometimes this is a good way to do it, because you can get very tight things. So what would be another example or way that somebody might try to take advantage of this situation? This is an example. But another example might be if you had an in-the-money call butterfly on a stock that pays a big chunky dividend right before the stock goes ex-div, and those calls need to be exercised, and you're kind of hoping that the person who's short doesn't do it. This is not a trade that a lot of retail gets into. Oftentimes they don't because this has a 6% annualized dividend, so you can imagine stocks trading 43. Let's just go take a peek. I'm going to come up with another butterfly scenario here. And actually, let's see when this is. Again, not a trade recommendation. It's not like I've been looking at Verizon saying, use butterflies to play for dividend spreads. But I'm just saying, if you happen to have one on and you get into a situation like this, you might find yourself in a kind of an interesting place. So Verizon, their next dividend is... The next dividend X date is July 10th. So, and it's a 67.5 dividend. Okay. So the stock was down. Let's see how far down this stock has been recently. We can use as an example because I actually think Verizon's been doing pretty well this year. It has. It's up from $38 a share in early January. Not surprising. People are looking for staples, or looking for utilities, or looking for stocks to pay nice dividends. Okay, so we can imagine then that perhaps somebody had on they said, oh, well, I'm going to buy a call fly that expires in July. And, maybe you bought you bought the at the money call, so you bought the 37s or 38s. Stock was trading around there. So we'll say you bought the 38s. You thought the stock could go up 5 10%. So we'll just say you're now going to be short the, what the heck, we'll pick the 42s, something like that. Those are in the money. And then you get long another one a little higher up. Doesn't really matter. It could even be a broken wing flies. We can do it like this. Okay, so you had that trade on. All right, so it looks a little bit like this. It's now gotten to the upside. Let's say you still have it on. You know, that was kind of your target price. Well, the interesting thing that happens is if the stock stays here or goes higher, so it gets up into this upper range. Let's say it comes over here, right? Now, notice what the P and L is on the downside, on this upper wing. It's 42 cents. It's a broken wing fly. You bought this call, you short 2 of these, and then you're long this one. And you have this P and L as of July. Well, here's the interesting thing. If the stock continues to rally, eventually, as the X date and the expiration date of these options are really close together, the folks that own those call options, if they do not exercise them, are not going to get the dividend. And if the extrinsic value of the premium of the value of that option comes down to next to nothing, they should be exercised. And you would want to exercise your long calls. You know this. You still have the upside calls, which have a couple more days left. But what's going to happen with those 2 that you're short? Well, there's a decent chance that maybe they don't get exercised. And if they don't, then essentially you get the dividend on the stock, the one lot that you got, and their calls are going to go down in value because they don't get the dividend, and the stock will drop by a like amount, all else equal. So there's this weird thing that happens where sometimes there's a real advantage to being short options if your counterparty doesn't know what to do. Now, of course, dealers and market makers know about this, and what they will do is they will try to get short that strike. So they will get up and down that strike by trading it with each other as many times as they can. They'll exercise all the calls they own and then hope that the counterparty doesn't exercise theirs, and you get away with a few. We used to do this in Philip Morris all the time. So, what Corey Henderson says, what is your best practices for when to exercise the long call? So, in this example, Corey, that we're talking about here in Netflix, you obviously won't want to make, if you own calls in Netflix, and I'm not suggesting that you buy them, and I'm certainly not suggesting that people get into convoluted trades that involve this expiration. If you're not 100% comfortable with the things I'm talking about, do a little bit more work or come back and watch this video again or put some questions in here and just tell me what it is you're not getting, and I'll try to explain it. So the only time you should exercise a long call is to say, file an exercise notice with your broker to do so, is before an ex-dividend date or some corporate action where you would receive some form of a deliverable as a holder of the shares to which you're not entitled if you are a holder of the call option. And therefore, the value of the call will just simply go down, but in a way that the underlying shares would not. And that whatever that benefit is exceeds the extrinsic value of the call option. What do I mean by the extrinsic value? If a call is $2 in the money, but the call is priced at $2.50, the corresponding put, that's the put of the same expiration as strike, is trading at 50 cents, but the value that you would receive as a shareholder is, call it a $1.10 dividend. Well, $1.10 is greater than 50 cents. That call should be exercised. Here's the thing. If ever you're confused about that, the better course of action is simply to sell. Sell the call option before that catalyst date comes. If you're kind of on the fence and you don't know before stock goes ex-dividend whether an in-the-money call option you own should be exercised, and you're trying to figure that out, don't do something that you're not sure of. That's the first thing I would always say. I think it was Scott Nations who was on Options Action quite a lot, and he used to say something that I thought sounded pretty good for a situation like this. It's okay to be wrong, but it's not okay to be confused. Don't start doing things if you're not sure that it's the right thing or the wrong thing, especially where early exercise is concerned. So the times to exercise calls early is in a circumstance where you wanted to get the dividend, so it's the day before it goes ex-div, and the value of the call, the extrinsic value of the call, is less than the value of the dividend. So do a little bit of work on that if you don't understand that concept, but that would be an example. And this is an example that we're experiencing here in Netflix, because if you own calls in Netflix and you carry them through the close tomorrow, and let's say you bet that, Netflix was going to go above 1,000, right? So nice round number. You picked 1,000 calls. And tomorrow the stock's trading right here. It's 961. So those things are almost $40 out of the money. And then they come out with a blockbuster number. And on top of that, they say a couple other things which are just too good to be true. And you get a number, a stock action that's kind of like what happened on earnings. What was it? Q2 22? I think it was a while back here. We had this huge upside move. Back here. Sorry. Over here. So Q3 23, stock rallied 16% on earnings. Now, if you owned the 1,000 calls and the stock goes up 16%, you probably want to do something about that, because that means that the stock is now trading $1,115. That means that call option, and let's see how much that call option is. We'll just go take a look and see where that call is priced as of today's close. So let's say you bought it today. You mark it on close. You bought that call option, and that call option is trading for $13. Okay, so that $13 call option is now worth $115 each. But it's only worth it if you exercise it, because it's expiring, and it expired out of the money as far as the OCC was concerned, because they're using the 961.63 closing price. You see that the stock's trading $1,115 after hours, but you see that it was not going to be exercised automatically. So you are going to give away that difference, and that's a big difference. That's going to be, just so I'm 100% sure I get this right, but that's going to work out to foregone $153.37 times 100. So that's $15,337 per contract. So, maybe you bought a 5 lot. It's a lot of money. So you're going to want to, if you want your $75,000, you're going to have to notify your broker and say, I want to exercise those call options. Of course, this does give you a different predicament now, because now you're long 500 shares at 1,000, $500,000 worth of Netflix. And are you comfortable carrying $500,000 worth of Netflix exposure through the 3-day weekend? Well, to solve that problem, you would notify the broker, exercise my calls, which could be an electronic process. It probably is. So if your broker works anything like Interactive Brokers, you just hit the trade thing, go down to options exercise the options, you buy the stock, and then you trade out of whatever portion of it that you want to after hours. So, because if you're buying 500 shares, you could just go ahead and sell 500 and lock in your gains. When you come in on Monday, you'll have no position. The options are gone. You exercise them. You bought 500 shares at the strike price of 1,000. You sold them after hours at $1,115, that is. Locked in $115 per share per contract. So it's $115 times 500. And you go on your way. So that is a circumstance where you absolutely want to know how to exercise. If you're going to wear options into expiration, you want to know how to exercise them, or also how to not exercise them. An example there would be if you own the 965 strike put. Well, as of the close, the thing's a couple bucks in the money. You exercise 500. Well, how would you feel about selling 500 shares at 965 if the stock's now trading 11.15? Not too good. I mean, not too good at all. That's a big whack. So you really, really want to be sure that you know what you're doing. If you're going to carry options that are expiring into expiration, and there's something big happening that could be market moving, understand these rules. Now, in fact, for a lot of people, this is one of the interesting things that is a big distinction between, I actually had this conversation with somebody, why I like SPX options rather than SPY options. And this is the reason. Because when I trade SPX options, those are cash settled. So whatever the settlement price is as at the close, if I carry the options all the way through expiration, which admittedly I rarely do, but if I did, and they're in the money, I just get the cash. That's it. If they're out of the money, I don't get anything. Whatever happens to the market thereafter, it's gone. So the close, this is the interesting thing. The close for a cash settled option is truly the close because that's the settlement price. There's no, nothing to do with what happens after the close and the settlement. But in the case of stock options and ETF options, there's that brief window that exists between when the market closes at 4 and when you can last exercise the option. And that can really make a difference. And normally it doesn't make a huge difference, but Netflix is reporting after the close, so now it does make a big difference. So I think this is something to think about. Again, if you don't know whether or not you should be exercising an option and it's still trading, it's probably better just to sell it. Do enough homework that you can figure it out, but things to watch out for are call options that are in the money, particularly ones that are deep in the money on stocks that have big dividends. That's something to watch out for. Okay, and what do we have here? So Jeff Brother says, better be sure they actually exercised and that the broker didn't screw it up before you go and start selling the shares you ultimately didn't get because the instructions weren't followed or done wrong. Yeah, I mean, you obviously, it's kind of like flying, I guess. I mean, I'm not a pilot, but I have a lot of interest in aviation. It is absolutely critical that you know where you are. You always need to, know what your position is. Are your wings level? How fast do you go? What's the velocity? These are things that are critical to a pilot, and it's critical to a trader. You need to know where you are. But this does present some other interesting opportunities. Now, what brought this whole thing up was the concept of calendar spreads, because you could also say to yourself, well, wait a minute, if I traded calendar spreads, and let's go take a look at an example of one of those, where I'm long and in the money call calendar in Netflix, and then I'm short a 985. So we're going to build exactly the trade that, as far as I can remember it. I apologize if I got this wrong, because there's a decent chance I did get it wrong. But let's say, so you're short the 985s. If I remember correctly, it was short the 985 calls, long the 1040s, 1025s. Again, I'm just going by memory here. So $40 call spread, short at 12 bucks. Okay, all good. Now, don't know if the stock goes to 1,000. I don't know whether the holder of the 985 calls is going to do the right thing and exercise them. We don't know, right? Maybe they will, maybe they won't. In addition, but if I'm covered because I have a longer dated call spread, so now in this case I believe it was the 25th weekly options, and I think it was a lower strike. It was like the 940s. If you're watching, maybe you. Oh, luckily, nice. So somebody on the production end paid close attention, and they saved it. Okay, good. So we've got the original trade. It was the 935s and short the thousands. Okay, so here we go. Well, check this out. Let's say, for the sake of argument, this is the trade. Okay. Now, this crazy picture is your P&L. And you will notice that if the stock gets up to, above 1,000 because you're short that strike, or the 985 strike, I should say, at 985 you see peak profits, but then it falls off thereafter because you're short the 985s. But the thing is, that's not 100% true, because those are out of the money. Maybe they're out of the money tomorrow. So if the stock runs and those don't get assigned, this down move between 985 and up here at your long strike, that's not going to happen. That's the beauty of this, right? And the thing is, you still got the premium. You sold them, you got however much you got for them. But if those things actually, if the stock rallies through that strike and they don't exercise the calls, then that's basically found money. That's $15 a share between 985 and 1,000 that you're going to get, $1,500, just because somebody didn't know that they should have exercised them. So it does create an interesting dynamic, and I think this strategy, it's not a terrible one for that reason. Now, it does have, you see that this has a very narrow spike, but that narrow spike is dependent upon the actions of some unknown actor who bought those calls. Now, the thing that's going to matter is those 985s, were those bought by a dealer? Oops, I shouldn't have done that. Got to go back to my... Are those in the hand of a dealer, or are those in the hands of retail? Well, oops. Now, I have screwed this up because I know how to zoom things, and then I didn't know how to undo the zoom I just did. So let me... Yeah, I'm trying to hold down the control and scroll out. That's not working. So, and that is not the fault of Unusual Whales. That is the fault of the user. I did that. So, no problem. Let's try a different browser. I'll do it that way. So, we're going to take a look. Come over here. Hopefully this one's actually logged on. And we'll just go back to the parent page. Okay, so now what I'm interested in looking at is I want to see the open interest. So I want to fix... Actually, this is good because now you actually get to see me kind of use it anyway. I actually preset this. And I want to filter this further because I'm only really interested in the open interest. So I'm just going to pick... .417 expiration, and what I'm interested in is the open interest. So if there's a lot of open interest on any given option, the chances that there's a lot of stuff in retail, that's as of today and probably as of tomorrow, depending on the flow. Late tomorrow, it's possible that dealers and market makers could start trading these things with impunity, trying to take advantage of this situation. They don't have incremental transaction costs, so they can do that sort of thing. But what we're interested in is, are those 985 calls, these are the those are the 995, so those actually don't have. So here's the thing. These options, they don't have huge open interest, right? And you initiated the trade against the street, meaning that the counterparty to your 985 call is almost certainly a market maker. They don't make these mistakes. If the stock's trading $1,100 after the close tomorrow, they will exercise that call and they'll sell stock against it, because that's one of the key areas that they're going to make money. So it's a little bit of a nuance, but one of the things that you want to think about when you build these strategies is you might want to try to think a little bit about the open interest. Normally, I don't focus on open interest at all, and I'm not assuming that you carry these positions all the way to expiration. When we do things like call spread risk reversals, these are basically set up so that you take advantage of the vol crush on the wings and the directional move in the stock. And once you've made your money, you take it off and you deploy that capital elsewhere. Generally speaking, carrying options positions all the way to expiration, it may not be the most efficient use of capital. There may be other things that you could and should be doing. But I realized when I started thinking about this one that this is important enough. Yeah, we should probably talk about it. Okay, so there are some other questions here. Let's see here. Anil. Can't expire Friday. Yeah, it's a holiday, so they just advanced the expiration date. So this is an interesting thing to think about. It used to be, when I first started trading options, that options expiration was technically the Saturday following the third Friday. So that was the official rule. So if you looked at the expiration date on an option, that was the date it provided. But for most traders, that didn't really matter because the market closed at 4 on Friday. That was the last minute to trade it. And then you had until, 5:30, whatever your broker gave you to exercise it. And that was it. Like, the technical expiration on Saturday didn't really matter because everything that you could do was done by 5:30. After that, it was out of your hands. Now, in our case, as dealers, we were always very interested in what was going on the official expiration day. There was actually a room at the American Stock Exchange, which I would go to sometimes on Saturday mornings, and just see whether there was anything really funky going on, because what we were interested in is really knowing for sure, how much did we get assigned on, what's our positions, do we need to trade any stock after hours, that kind of thing. But for your purposes, expiration is not the last minute that you can trade it. It's the last minute you can do anything. Or it's the last minute that something can happen to you. If you are long an option, you can exercise it if it's out of the money and you realize that now it's in the money because the underlying has moved. If you are long an option that was in the money as of the close, but now it's out, you can instruct your broker, do not exercise. It's called a contrary exercise advice. You can put that in. And then maybe you want to do something in the stock to correct it. But this is, again, this is kind of an inside baseball thing, and normally it doesn't matter, and normally I don't talk about it. But tomorrow there's a ton of open interest. This stock's going to move, and normally that doesn't happen. So I figured it would be kind of an interesting topic. Okay. What if a debit put spread is in the money at the close? So Anil, the important thing to you is if you own a debit put spread and it's in the money at the close, but it's not in the money 30 minutes after the close, that's the important question. So if you own the 975, 950 and you're long the 975s and earnings come out, they blow the doors off, and the stock's trading 1150. You don't want to exercise that put. It will be exercised automatically because it was in the money as of the closing price as far as the OCC is concerned. D&E. Do not exercise. Put in a contrary exercise advice and don't exercise it. If you want to be short 100 shares of stock for every contract that you own, you'd rather sell it at whatever the after-hours price is than sell it at the strike of that put, which is now much lower. Save yourself some money. Okay. Monday Morning Quarterback says, for Netflix, I'm thinking buy stock, sell the 15 delta straddle. I'm bullish after market hours. After earnings, price could move. Well, I'm assuming that's what you're saying because I only see it until could. There's probably a follow-up to that. But yes, that is true. I think that the safest way to play this is with some form of calendar spread, and then maybe you get away with some, right? And I think that's what the question that was presented to us on Monday was all about. You could also, you could get quite creative with this, right, depending on your thesis. An example would be, let me kill this. So let's just say, now what's the problem with a calendar spread? The problem with the calendar spread is vol crush. If you own options that are farther out in time, so you think there's going to be a big move, and you're hoping that somebody who has April 17 options doesn't take advantage of it. But you're also worried about the vol crush because vol's really high, and that's a fair thing. It doesn't help you to own a call and the stock shoots up, but the vol crush is so bad that you still don't end up making any money. So it's kind of interesting because this is something that people would trade in natural gas futures around the shoulder months, but you can also have spreads that go out more than one. This is kind of deep end of the pool stuff, not necessarily recommending the trade, but I want to illustrate a point. Let's just modify this strategy a little bit here. So let's say you're short the 985 calls, and then you're thinking, well, maybe it gets there, so I want to be long those the following week. But the problem with that is, we'll get rid of this option for just a second. All right, so now I've got this call calendar. Oops, wrong expiration. So I've got this call calendar spread. Looks like this, right? So I want to collect the decay of the near dated option and then have the one for the following week, sort of capitalizing on the notion that maybe next week you're going to get some movement following earnings, which you probably will. Okay? So you put that trade on, it costs you $1,500. Thing is that implied volatility for next week is probably, what, 80 now? Let's take a look. What's the 985 implied vol for next week? Woo! How you doing? What did I say? 80. I was off. It's 75. It's just a stab in the dark, a little guess. Okay, so I was off by 5 vol clicks. But you're thinking to yourself, well, it's 75 now. What's it going to be on Monday after the news comes out? It's not going to be 75. It's going to be 35 maybe, right? And could go down even further. So if we just take a look at that option and say, all right, well, at 75 vol, that option is worth $35 in round numbers, right? Now the stock goes up to my 985 price. So that was a win. It didn't really blow the doors off, but let's say it just goes up to that stock price. And now I think the vol is going to be 35. Well, now that option is $22. So that's not really a huge win, is it? Right? So I put this trade on for $15.34, $15, and now it's $22. So I made $700 on a $1,500 bet. Well, that's not terrific. What if we tweak this a little bit more and you said, okay, well, I like owning that option, but I need to collect some premium that's going to get whacked a little bit more. What if I can short a 985 that's got more Vega to it? What would have more Vega? Let's pick a Tom Sosnoff option, right? They love to sell out 40, 45 days, if my memory serves, like 6 weeks-ish or so. Where's that option trading? So now we can take a peek at the May 30s. See what that option is worth. So, we can see what the price is in dollars. It's a $65 option. But we need to do a little bit of modeling here so we can kind of figure out what will happen to this thing after earnings. And I'm going to actually show you because I think I have a tool where we can just see what that vol crush might be. This is just a little bit of scenario analysis. Just what do we think could happen in different cases? What do we think vol might do? All right, so that thing is trading at 48 vol. It's a $56-ish option. Well, that says 65 on that one. Oh, here. Is that? Oh, my mistake. That's what I've got wrong. It's not the same strike. It's like I knew something's not quite right here. So $54 option, okay? So now we've got this trade on. How much is this option going to decay? Well, same thing. Let's just play it out a little bit and say, okay, let's take that one also down to, I'm just going to use round numbers, 35 vol. So that option is going to lose $18 on a standstill basis. at 35 vol. So that's, one thing that you can think about is just getting a little bit more creative with those calendars. So, and I'm being creative simply because I'm thinking to myself, well, maybe, just maybe, this one doesn't get exercised. Stock trades to 1,000. It should have been exercised. It wasn't. And I kind of get the freebie. Now, like I said, statistics published on this vary. 10 to 20% of options that are in the money that maybe should have been exercised are not. But I think that percentage, certainly in retail hands, is going to be higher in the case of Netflix because of this unusual circumstance. Monday Morning Quarterback makes the point, retail is likely to be long options, not short. Well, that's right. I mean, how many people who are trading on Robinhood are saying to themselves, I want to sell the 1,000 strike calls in Netflix? That's not usually the way this goes. Retail is more commonly going to be long the short-dated stuff because they're looking for that quick hit. They're looking for that 2, 3, 4 to 1 payoff. But you need to find strikes that have a lot of open interest if you're going to play against it, right? You sell something that's got no open interest, you just sold it to a dealer, they are going to do the right thing. Because if they didn't do the right thing, they wouldn't be in business. And I have seen this. It's happened. Many years ago, probably 15 years ago or so. You can probably look it up. I'm sure you can Google the story. It was Merrill Lynch. Merrill Lynch had a bunch of options they were supposed to exercise. They didn't do it. And it was a huge hit. It was like $60+ million. One clerical error. And I've seen the same thing happen in the pits. When I traded Philip Morris, because we'd do these kinds of trades going into dividends. So people would do dividend call spreads. There was a brown stripe in the crowd. Brown stripe. So new traders, the Amex badges were blue and red, and it had your acronym on it, and it had your clearing firm and number on it. And then we also had a separate acronym badge. But anyway, that badge was on there. If you were a new trader, it had to have a brown stripe on it. And that helped other traders know that trader was new to the crowd. And so you would have to sort of kind of double check your work with that person, right? And they often would refer to, hey, brown stripe, to the new person in the crowd. And, brokers and other traders would really want to make sure, okay, you got this written down. We know what we're doing, right? Everybody good? Well, there was an instance in the Philip Morris crowd where somebody did not. Brown stripe saw all these people trading these call spreads. Hey, do you want to do some? Sure. Figured if they're doing it, probably want to do it. Maybe that guy's boss just told him, do what everybody else is doing. Because, you're figuring that the rest of the crowd knows what they're doing. So just do what they do, and you'll be fine. Well, if you do that and then you don't know what they're doing at 5 o'clock, like exercising their long call options, you didn't follow them to the bathroom either. You missed out on a really important part of the trade. Sometimes what you do outside of trading hours is critical to your P&L. And this is a good example of that. And yeah, such was the case in the Philip Morris crowd when the guy didn't exercise his calls and he lost all those dividends, and it's a big loss. Okay. Anil says, what is the scenario for Netflix tomorrow? Short in the money put before noon. Stock closed below your strike, and the stock goes above your strike after market and becomes out of the money. Will the buyer broker exercise? So, yes, this is exactly the kind of thing that we're trying to figure out, but we don't know for sure. Because remember, all of the options that should be exercised will be exercised if the person holding those options is a pro. If you watch this video, if you know what you're doing, you won't screw this up. You're not going to buy the stock for $9.50 if it's trading $8.50 after hours, will you? Right? So you know that. Every professional knows that. Who doesn't know that? The guy who doesn't know that is the one that bought the $9.50 calls, it closed at $9.60, and then got in the car with his golf clubs and headed to Palm Springs. That guy doesn't know because he doesn't even know what's happening. He doesn't even realize the stock is trading $800. So his option will be exercised automatically. That was the courtesy afforded by the OCC. That's just a process. That just happened. Same thing is true if he owned the 900 put and the stock was trading 950 after the close, and then it trades to 850 after the close. He should be exercising, but it won't because the OCC looks at the closing price. 950 closing price, 900 put strike price. That's not an automatic exercise. It was not at least a penny in the money, so nothing done. He loses $5,000, $50 times 100 per contract, right? So that's the people who are not going to exercise are the retail. Now, the more institutions play against that short interest. So let me walk you through an example so we can estimate, right? So if you're looking at something and you watch and you see that the open interest rose by a couple contracts every single day for the last, we'll call it 8 weeks. So there was zero open interest 8 weeks ago. Now there's, call it 2,000. Okay, so there's 2,000 open interest, and every day you can see it's all little pieces, all little lots. Who owns that? It's all retail, of course, right? Because it's all small pieces. Then, right before expiration tomorrow, you see a 2,000 lot block trade. Retail doesn't trade 2,000 lot blocks. Both sides of that trade are institutional. Doesn't matter who bought or sold. Whoever owns them knows what they're doing. You have to bank on that. So now what you can say to yourself is, well, okay, 2,000 of the open interest is retail. 2,000 is definitely institutional. We know that. And we know the institutional guy is not going to screw it up. So we can bank on at least half getting exercised because smart money represents at least half the open interest. They will execute if it's in the money. What about the other half? Well, some people are going to be savvy enough to do this. Some won't. And if you are now short those contracts, you know that about half of them are guaranteed to be exercised. And let's assume that half of the other half are pretty smart and know what they're doing. So they do it. Okay? So now 75%. If you're short a 10 lot, you're probably going to get away with 2 or 3 of them, right? Because the way the assignment process works is it's supposed to be kind of pro rata, pari passu, right? If we think about it like that. It's not supposed to be some kind of a windfall gain. Now, it does happen that sometimes somebody just lucks out and they don't get assigned on any that they didn't want to get assigned on, and somebody got somewhat more than their fair share. But the process isn't supposed to play favorites. And it's also not just supposed to be dumb luck. You drew the short straw. I'm not going to say that distinctions don't happen, and they have to, because it might not work out to even numbers. They have to allocate it to all of the clearing firms that have positions, and then the clearing firms have to allocate to all of the sub-accounts. So that process is going to, it's a messy process. It's going to be imperfect, and sometimes it's imperfect because it's mathematically impossible for it to be perfect. If you're short, if you're short one put, and 75% of them get executed. Well, here's the thing. If you only have one put, you can either be assigned or not assigned. So either you're kind of get an unfair deal because you got assigned, so you are out 100%, or you got really lucky and you didn't get assigned, so that worked out for you. So you can't be sure. You have to try to make an educated guess based on the things that you know. If you're using tools that, where you can kind of track open interest. I had already screwed up the unusual whales thing because I blew up the size of the screen. But if you can track the open interest and kind of see how it built over time, and then if you have something that alerts you, hey, big block print. That's the reason those kinds of things are important, by the way, right? Because you want to know who you're up against. Now, if you sit down at the poker table and, you see some famous guys that you recognize from Poker Stars, well, maybe you want to try a different table. When you see a lot of big block prints going on and your game is that you're hoping they won't exercise, don't count on it. It's retail that's much more likely to make that mistake. And it's not a mistake. It's more of just an oversight because there's that very brief window. I mean, think about this. you can only exercise until 5:25, right? So the market closes at 4. You've got 85 minutes to make that happen. So that means you're there, you wait for the earnings, they start the call, the numbers come out, stock's kind of bumping around, it spikes up, it comes back in, the call starts, right? So you're waiting for a lot of things to happen. The call's going to take some time. People are going to ask some questions. How much time do you really have before you get some sense of where that stock's going to be trading? You need to see it settle in. That's probably going to be 5 p.m. Eastern time, 2 o'clock Pacific time tomorrow. And you have to put in your advice by 5:25 on the interactive platform, or whatever will be, right? Then it's just going to go on the automatic exercise rules. So these are the kinds of things where, it's a little bit of an inside baseball kind of a deal, but, it's better to know these things than not, right? Because you might be able to do something about it. Okay, so let's see here. Monday Morning Quiet. Back in the 90s, expiration was trade matched on Saturday since we traded paper tickets. Yes, that's right. I traded on paper tickets. It may surprise some of you to know that I traded paper tickets after the year 2000. Although it was not on the PHLX, the Amex, the SIBO, or the Pecos. There was an exchange that I was a member of where we still traded on paper into the 2000s. That was the NYMEX. New York Mercantile Exchange, where we traded futures on oil and gas, the products, all that kind of stuff. Those were paper tickets. You would write the paper ticket, and each ticket had 4 places for trade. So you could write 4 trades on each ticket, and then there was multiple parts of it. A soft part, you'd stick that in your pocket, and there was a hard part that was made of cardboard, and it all was, basically like, copied on that. You'd rip the hard part off, and this would seem ridiculous. You would throw that card in the air, and an exchange official would catch it, and they would book the trades, and then you'd see it come up on the last print. So you'd write it, and as soon as you filled up your card, rip off the hard part, fling it, and it flew kind of like that down to the center of the ring. And those exchange guys, boy, they could catch these things by the corner. So there's cards flying all around, and they would just grab it. It's quite amazing to see it. I'm kind of bummed out that they don't do that anymore. I wish I could have brought my kids down there. It doesn't exist anymore. It's all electronic now. But yeah, it's hard to believe. That was 2001, too. Still doing it that way. Yelling, screaming, and throwing paper all over the place. Seems nuts. But it worked. Will advertiser pullback by Chinese companies affect Netflix? James Forbin asks. It's a very good question. I'm not sure that I know the answer. Here's something that I actually was thinking about, though, which is, this was almost all U.S. revenues. And, we keep thinking about China, like that's the big problem. What's going on with China? China. One of the things that occurred to me, of course, is that, we are getting to a point where they're starting to derive revenues outside of the United States. And you can see that here. And that, as a share, was supposed to be going up. And it is a question, what about services? If we're going to start having tariffs on goods, what's going to happen on the services side? How's it going to affect? Yep. So, yeah. So this is really the issue. And I want you to see how big an issue it potentially is, right? Can I blow this up? I'm going to blow this up, and then I won't be able to down shrink it again. But I want you to see just how big a percentage this is, right? So this is the full year forecast revenues, U.S. and Canada. And by the way, we are squabbling with Canada a bit, so let's break Canada out as well. So of North America, 1.7 billion estimated full year for that. But take a look at Europe, 13.8 billion. That's not inconsequential. Latin America, 5.4. Asia Pacific, 5.3. And these numbers are all rising. So it is a consideration, and we're probably going to hear about that on the call. So I think this is something else to think about. Now let me just scan through here. I just want to make sure. So I just want to see how many questions I managed to get to and see whether I'm missing anything really important. Yeah, so this is Tucker D. Dog said, bigger tariff threat to Netflix as other countries start to increase digital services tariffs. That's right. And you can see what kind of revenues we're talking about. I think this is important. Strangle swap. Yes, PC asks. So that the trades I was just talking about are very similar to. Why wouldn't that go down? Are very similar. Now I think you guys know that when I like the strangle swaps, it's usually I'm trying to just own premium longer term. I think it's at an attractive rate. I try to stack catalysts in the middle. I get an opportunity to trade some gamma after the short end rolls off. I'm not usually that enamored of, say, buying 6-7 week strangles. But in this particular case, what's interesting is that just a 1 week strangle swap, if you're choosing strikes with a lot of open interest on the 17 side, that might be a way to play this. I might do that tomorrow because I'll be honest, I haven't actually experienced something like this that often because it's not that common for big companies with a lot of open interest that typically move a whole lot to report at expiration because they don't typically report Friday after the close. And Netflix is an exceptional animal. It tends to move a lot, and it's got a lot of open interest. I mean, there's just a whole lot of stars that came into alignment in Netflix case. And on top of all of that, we've got a stock that is up while everything else is down, and we don't know whether the tariffs are going to come in, and maybe they'll talk about it. This thing could really move. Doesn't have to. I think if everything is in alignment as far as their operating stuff is concerned, and they can talk down the risk on the tariff front and things like that. I mean, look, I was just showing you. I mean, the company's been growing fabulously. Free cash flow is growing at a great rate. I mean, full year free cash flow, we're looking at year-on-year free cash flow growth. And we're going to end this soon because I know I've been keeping you 23% with a free cash flow yield of, over 2%. And then, again, next year's anticipated free cash flow growth, we're looking at another 30% year-on-year, $11 billion over 40. So you got, 2 3/4 free cash flow yield with a 30% free cash flow yield year-on-year growth. These are good numbers, right? And it's a services business, so it seems great. But they're not totally immune if they start going after services. And I think this thing could really whip. And if you happen to be short the April 17th, just really be aware. And if you're long the April 17th, also be aware this stock could move after hours, and know how to put your DNEs in or know how to put your exercise orders in if you find yourself with an option that expired out of the money that you now want to exercise, or you had one that was in the money that you now don't want to. Figure out how to do that. If you don't know how to do that, close your option before the close, because the last thing you want to be, and as far as I'm concerned, it's 5 o'clock and you're thinking, how do I do this now? If you get in touch with trade support, I had a problem with trade support last week. It took me 90 minutes to get through to somebody who could finally help me. 90 minutes is too late. 6:30 East Coast time. OCC doesn't care. They can't help you. You'll end up in arbitration, so don't do that. All right, you guys, I spent the whole time, way over an hour, talking about one stock and talking about a really wonky topic. But you can see that I think it's kind of interesting. I think it's kind of fascinating, frankly. You just don't get this kind of situation that often. And so I figured if I was ever going to talk about it, today's the day. Because tomorrow it happens. We're going to see what happens. We're going to talk about that next Monday and maybe on Friday, because I think maybe Brian Stutland, he was unable to join. Zoom was down, folks, by the way. That's another interesting stock to watch. Zoom crashed. So people who dial into this show, they use Zoom. And it was down apparently worldwide, and it was down for something like 20 minutes. That's a big outage. What? How many hours? Did you say? Yeah, at least an hour. Yeah. So, yeah, Zoom may still be down. So that's another stock to watch. Keep your eye on that one tomorrow. All right, everybody. Thanks very much for watching. And we're probably going to be doing something on Good Friday if Zoom's working, because if it's not working, I'm just going to be talking to myself. All right, folks. Thanks for watching. See you next time.